Welcome to Investor's Guide, and thank you so much for tuning in. We have an extremely special show lined up for you today. So I'm going to give you a moment to grab a pen and paper before we start. The first thing you should write down is my email ID, which is at the bottom of your screen, where you can send in any question you have about your money, whether it's spending, saving, or investing. Now on to the show that we have lined up for you. Even though we spent the entire year reminding you repeatedly that you should get your tax-saving investments out of the way, I'm still getting emails from you asking me about one last-minute option. So what I've done this week is I've brought in a big gun. Shailesh Haribhakti is the biggest tax expert in the country and frankly, personally, my favorite tax expert. Mr. Haribhakti, thank you so much for coming in. It's such a pleasure.
Great pleasure to be here.
We're really grateful that you made time for us this week. Now, like I was saying, we have a lot of viewers who've written in. We're in the month of March and people still haven't done their tax saving, which gives them exactly 1 month to get this done. Now, the thing that worries me most about this situation is going out to your bank or calling your agent and just buying the first thing he makes available to you, which is such a bad decision. Tell us why we have to make sure that it falls in line with the rest of our investments. It falls in line with the rest of our plans.
It's very important to do planning over a 12-month time horizon. This is not done by most people because they don't have that discipline to sit down and look at what their cash flows are going to be, when is the large chunk of income going to come, when is the steady income going to flow, and all of that. For example, take ELSS, which is the last minute thing that everybody will rush out to do.
It's the favorite last minute tool.
Now, just making sure that you invest in the ELSS at the beginning of the year in a thoughtful, well-planned manner, choosing the best ELSS that you can find in terms of reputation of the fund house, in terms of track record of the investment manager, the portfolio, take a look at it, eyeball it. It is not so automatic to just choose any ELSS. It is important
you know,
to go
the thing that worries me more about ELSS, one is choosing the fund, and we have so many choices in our market. The second thing is, what if I put my entire 1 lakh rupees in an ELSS in one day? What is the risk I'm running in that case?
See, the biggest lesson that we have learned in terms of equity investing or equity-related investing is that if it is systematic, then you're not timing the market. The best way to invest in ELSS, perhaps, is to put away 1/12 of what you are planning to do every month. In which case, over the whole year, you will get the entire wave of ups and downs in the equity market, and you're not bothered. It becomes a systematic investment that you're doing. And to my mind, that is the best lesson that I can leave behind for people who always catch the ELSS in the last month.
Okay, so that is a lesson that we can use April onwards.
Absolutely.
What is the lesson we use in March right now? If I haven't done anything yet, what equity-linked investment can I make to save on tax? And the choices are between a ULIP and an ELSS. How do I choose between the two? How do I decide which one I need?
Again, I think it's the same considerations. I would prefer an ELSS because it's an easier, simpler, well-understood, well-worn mechanism, provided you choose the fund house with the best track record and the highest reputation, and with a return which has been superior to the average. If you can do all of these three, and you can, then I would say that choice becomes easier. I would not do an allocation between an ELSS and a ULIP.
But for those of our viewers who put their money in, say, 3 years ago into an ELSS, which is now out from its lock-in, and if I don't have enough money at this point, does it make sense, now that it's tax-free and lock-in free money, to take the money out, put it back in again in the same fund and claim the tax benefit?
In certain circumstances, it might. If you are a systematic investor in equity, in any case, you'll keep wanting to add to what is your current stock. And therefore, this question will not arise. But if you are really stuck for choice and you do not have the cash flow, then this is an option that you would exercise.
I also want to ask you about life insurance. Since we talked a little bit about ULIPs, for me, the bigger thing, as far as our viewers are concerned, is to make sure that they have enough of a life cover, which can be easily, done with a term cover right now. And again, we've talked about this for so many years. If I'm watching at home and I'm thinking, yes, I need to buy life insurance, yes, I want to have my family protected, how do I arrive at the amount that I should put away? Should it be because this is how much I need to save on tax? Or should it be because this is the kind of protection I want my family to have? How do we arrive at that amount?
None of the above. What you need to really do is to assess what are the risks that are attendant to you and your family. So you need to really do a risk analysis. That should be the basis of working out your insurance. So if you are already a house buyer and you have EMIs, then you need some protection to make sure that those EMIs getting paid. But if you are not a house owner and you have decided that you want to rent, then you're not worried about EMIs. So it is not an easy, straight out answer. You need to do the risk management.
All right, you need to find out exactly how much life insurance you need. And of course, this is a number you have to revisit at least once a year.
Absolutely.
As soon as things change. Yes.
Every year is critical.
All right, let's take a couple of questions. Karthik has written in. He tells us he's working in Bangalore. He jointly owns property in Coimbatore with his mother, and his mother is currently living there. He has been living in rented accommodation in Bangalore up till now. He's been claiming tax benefits on his home loan with his mother. He's now bought an apartment in Bangalore as well. He wants to know how this will affect his taxation, and can he claim tax benefits on two home loans at the same time?
The maximum number of homes that you can own and get away with a deduction is 2. So that is the upper limit in any case. The deduction is available qua the EMI payments that you're making on a house, which is not outside your 1+1.
Yes.
Not only is the interest, but the amount that you pay out, even the capital portion of it, is available for tax deduction. So you need to be, and you have to make sure that these two are distinguished, because one is under a cap, the other is not under a cap. So you need to do a little bit of computation to make sure how much to claim and to what extent.
Sagar has written in. He tells us his annual income of 6.5 lakh rupees, and he's now applied for a home loan. He wants to know if he should invest any money right now in a tax-saving investment to save on tax. Now, he falls into the 20% tax bracket. I'm assuming his home loan will take care of a lot of that tax benefit.
I would assume so, but he has the choice of insurance. He has the choice of putting into ELSS, and he has a choice of going in for tax-free securities which are available, which will put him completely outside the tax bracket. And the yields on those are today fairly attractive. So these are the 4 categories that he should look at.
All right, Sagar, we hope that helps. Now, remember, if you have any more questions about your taxes, write to us. Our email ID is at the bottom of your screen. Welcome back. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. I have a really exciting guest with me in the studio. Shailesh Haribhakti is with me in the studio. We're talking about saving tax last minute, but we're trying to do everything we can to help you out. Now, Mr. Haribhakti, we talked about the equity options, ELSS, ULIPs. There are debt options available as well. There's a 5-year fixed deposit. There's a public provident fund. What would you recommend that we use right now this year if we're putting our money away? Do you think the public provident fund is the most efficient debt investment available? Absolutely
a must. Any person who is earning income of a sizable quantum, where, as you said, the rate of tax may be 20%, must consider PPF, because PPF has the best post-tax return over a very, very long period that we've been tracking it. And even today, the PPF is a very, very attractive investment. It becomes compulsory. It helps you to save. It locks in your saving. You, at the end of the lock-in period, you have a large capital sum that you can withdraw without having tax consequences. So all of this makes PPF a very, very important part of the investment strategy.
I have a couple of rebuts to that. One is, what if I already have my PF being deducted from my salary? Then doesn't it become a double effort? Secondly, a lot of investors find the PPF cumbersome because it's not the most efficient system to enter, besides which it locks me in for 15 years, and that's a really long time. Yeah. So, first of all, my first question is, if I have PF already being deducted from my salary, can I skip the PPF?
You should. You must consider it. I think, again, you must look at whether you can put away savings for 15 years and whether it will make good sense for you to have some lump sum coming back to you after 15 years. For some purposes, it may become very effective. And therefore, you need to have your life-saving plan, and you need to have all your lumpy commitments clearly articulated in order that you can do good planning.
There's another argument that comes up when we're talking about a 15-year investment, which is that over a period of 10 or 15 years, equity always does better than a debt investment. In that case, then, does it make sense for me to use a PPF, or should I be using a mix of the two? Wouldn't it be more efficient if I put that money in equity? How do I decide?
Definitely a mix. Definitely a mix, which will be driven by your propensity to take risk. And that is driven by the level at which your income is rising. So once you have figured out whether your income is on a strategic rising curve and you have a certain lump of savings to take care of, then you start allocating.
Let's also talk about the 5-year fixed deposit. It's an option available to us. Given the fact that it's an option available alongside the PPF, do you recommend the 5-year fixed deposit to anybody at all?
I recommend it only when you have uncertain requirements for borrowing against the fixed deposit. It becomes a very valuable thing to have. A bank gives you very readily, with very little margin and with very little incremental interest, a overdraft on your fixed deposit. And that is the attractiveness of the fixed deposit.
So if I have money to put away, but I don't know if I'm going to need it back in the next 5 years, then it makes sense to use the fixed deposit.
Absolutely.
One thing we've not talked about so far is the NPS, or the new pension system, as it's called. Again, this is something we've been watching for 5 years. It's evolved a little bit. Is it in its current form attractive as far as you're concerned? Instead of doing this really complicated mix of buying equity, buying debt, can I just buy the NPS and forget about it?
I must disclose my bias. I happen to be a member of the NPS Trust, and therefore what I'm saying must be viewed in that light. We have a very good choice of schemes in which you can put away. And the NPS scheme, I think, provides a very, very good option to people who have a long-term horizon for a portion of their savings. For such people, it makes immense sense to get a mix of debt and equity exposures. And that is available through the NPS scheme. And for that purpose, I would say, if you allocate about 15 to 20% of your saving to NPS, you might turn out to be a winner.
All right, so NPS is something you recommend, obviously. Let's take a few more questions. Samasuddin has written and writes in from Pune. He tells us his sister is an American citizen who has an NRE account. 4 years ago, she made a PAN card to buy a flat in India. The Income Tax Department has now sent her a notice for not filing her returns. He says, since NRIs already pay taxes in the country that they're residing in, does she need to pay taxes in India? Does she need to file her returns in India? If yes, then how should she do it?
The answer to that question will depend on whether she has taxable income in India. If she has much below the taxable threshold income, then she need not file a tax return. But she does have an obligation to prove that no portion of her global income should bear tax in India. So therefore, as a defensive strategy, it may make sense, if you have significant investments in India, to file a return and to establish your credibility that you have considered all your sources of income. Some of them have no bearing to India, no bearing to the fact that you are a non-resident Indian, and make sure that that happens. Then you will not have any palpitations when a notice from the income tax department comes.
So basically, she needs to make a list of all of her investments and see what they've generated over the last 1 year. Add that all up. Make sure you're below the level that needs to pay taxes.
Absolutely.
All right. Let's take another question. We have a question that's come in from Anup Kumar. He tells us he's a salaried employee and his company deducts the monthly TDS, which everybody's company does. He also has a home loan that covers all of his ATC requirements. He wants to know, is there any other way he can save tax right now? Because he's done with the ATC, he's done with the home loan interest deduction as well. Can he set off the depreciation of his home against the interest on his home loan? Is that something a salaried person is allowed to do?
Unfortunately not. That is not a part of the, because there is a deduction which is available for the EMIs you pay, both on the interest portion as well as the capital repayment portion, as we discussed earlier. And therefore there is no provision to offset the depreciation. But one of the things that people do attempt to do is, if they have an activity in addition to their salaried employment and that is permitted under their employment contract, then there might be a consulting activity or some other activity for profit that they are indulging in which case a portion of the costs that they are incurring on maintaining a home, and if they are working from home, can be considered for the purpose of deduction from this kind of income.
But if you're purely salaried, then those options are not available to you, unfortunately. Welcome back. You're watching Investors Guide in ET Now. Thank you so much for staying with us. Our email ID is still at the bottom of your screen. Send in any question you have about tax or about anything else to do with your money. Shailesh Haribhakti has been kind enough to answer our questions, and he's still with us in the studio. One of the things we haven't talked about, and I know you feel so strongly about this, health insurance. And it's an added deduction we get. How important is it for each and every one of us, irrespective of what our employers are giving us, to go out and buy health insurance?
Very, very important, because health insurance is available not only for yourself, but for one generation above you and one generation below you. And you need to consider that bad luck can visit anybody, and therefore health insurance is absolutely mandatory. To the maximum extent that is possible, you should be insured.
Let's talk about our 8 or 10 metros right now. If I live in any of these cities, how much health insurance should I have for a family of 3 or a family of 4?
See, the hospitalization costs have gone up quite remarkably. A bypass surgery can put you behind by 6 to 10 lakhs of rupees, and a small operation can cost you 50,000 to a lakh of rupees. So there is a vast range of possibilities that you need to. But the easy rule for somebody who doesn't want to apply too much mind is to max out the possibility with a tax deduction which is available. So I would say go to the maximum that is permissible to you under the tax laws.
Go to the maximum. Also remember, you can buy these policies online. There's severe competition in the market. They're driving the prices down, which is good for you and me. And there are also policies that cover everything. Another very quick question to you. Tax-free bonds. These are different from the infrastructure bonds that we could deduct under ATC. How do tax-free bonds work, and which of us should be using them?
Tax-free bonds have a large lock-in period, and they are illiquid by their very nature. It is only the informal market in which you can trade in them. So if you have no real identified need for some portion of your savings, then tax-free bonds make a lot of sense. Or if you have a very large lumpy capital gain that you have just received, then it may make sense to put away a portion of it in a tax-free bond, so that the financial asset keeps taking care of your lifestyle costs.
For those people who perhaps sold a home and they're looking to buy another one in the meantime, so you don't have to pay tax on it.
That is one. And even where you have a large surplus, because sometimes the quantum that you make as a home, if you bought it before 20 years, can be fairly significant.
Well, just to make it clear to our viewers who are watching at home, a tax-free bond, what that means is that the interest it generates is free from tax.
Completely free from tax.
All right. The principal amount that you put in is not tax deductible. That was an infrastructure bond that is not available to us this year. Let's take another question. Kalpesh has written in. He tells us he recently moved to the Middle East. Well, congratulations to you on that new job. He receives his income in dollars right now, and he's opened an NRE account. Now, he says he understands from watching the show that he has to spend 183 days outside of the country in order to qualify as an NRI. Can he take a holiday outside of India to add up to 180?
The test is very simple. Presence, absence, as completely shown by your passport. The entry in, entry out. That is the established test for proving that you're a resident or a non-resident.
All right. And now that he's not finished his 183 days, he's already opened the NRE account. Does it make sense for him at these interest rates to open one of those NRE fixed deposits as well and take advantage of that option?
I think so. I think we are in an interest rate cycle which is almost at its peak. I can't say for sure that it will be, but I can sense that there will be a gentle decline over the next 6 months, and therefore it may make good sense to lock in an NRE deposit.
All right. That, unfortunately, brings us to the end of the show. We've run out of time. That was the quickest half hour of my life. If you have any more questions for Mr. Hari Bhakti, feel free to write to us. We'll ask him to come back into the studio and answer your questions for you.
Thank you very much.
It's been such a pleasure to spend time with you. Thanks for watching. My Twitter ID is at the bottom of your screen. Get in touch. It'll be good to hear from you.